Welcome to The Explainer. I'm really thrilled to have you here today. Look, if you've been watching the markets lately, you know we're living through this incredibly dynamic period where literally one single headline can send shockwaves across every asset class on the board. Today, we're breaking down a really fascinating cascade of events. We're going to look at how a geopolitical shift halfway across the world is completely rewiring the dynamics between oil, inflation, the broader stock market, and, of course, precious metals. So let's dive right in. $4,210.10. That is exactly where spot gold was trading early Friday. Just an absolutely massive, high-stakes financial environment we're operating in right now. At these historic levels, gold is highly sensitive to the broader macroeconomic winds. But, to understand why gold is holding steady right at this specific price point and why silver is actually seeing a bit of weakness down around $67, we've got to look way beyond just the metals market itself. To make sense of this whole complex web, we're going to connect four distinct pillars today. First, the inflation anchor. Second, Hormuz and de-escalation risk. Third, the market ripple effect. And finally, number 4, gold and silver technicals. Section 1. The inflation anchor. The battle the Federal Reserve is fighting right now really couldn't be clearer. On one side, we've got the May Consumer Price Index, or CPI, showing headline inflation running at 4.2% year over year. And on the flip side, the Producer Price Index, the PPI, is running even hotter, rising 6.5% from a year earlier. This data right here, it's the ultimate macro anchor, holding things in place. It's keeping the Fed rate channel highly restrictive. And for precious metals like gold and silver, high interest rates are typically a major headwind, right? Because they don't yield any interest themselves. So this inflation data acts like heavy gravity, keeping gold from just floating endlessly upward. But something major just happened to ease that pressure. Section 2. Hormuz and de-escalation risk. Now, I want you to watch how this specific chain of cause and effect plays out. Step 1. Headlines hit about a potential U.S.-Iran agreement. President Donald Trump called off planned strikes and noted that a peace deal could potentially reopen the Strait of Hormuz, which is one of the world's absolute most critical oil choke points, as soon as the weekend. And while Tehran noted no final decision had been made, the market immediately began pricing in de-escalation risk rather than a new supply shock. That leads directly to Step 2, a sudden drop in oil prices, which triggers Step 3, softer U.S. Treasury yields, as those inflation fears cool down. And finally, Step 4, that exact relief allows equities to rise. Let's actually look a little closer at that oil drop, because the sheer scale of it is vital. We saw Brent crude abruptly fall from overnight trades near $93 a barrel, straight down below $85, before finally stabilizing near $87.50. The NYMEX WTI crude saw a similarly sharp decline. So why does this matter so much? Well, because oil is the primary engine of inflation. When the prospect of normalizing crude flows through the Gulf becomes a reality, energy prices drop. And when energy prices drop, that heavy energy inflation pressure that dominated the midweek trades suddenly eases right up. Section 3. The market ripple effect. The sheer relief felt across the stock market was immediate. With oil prices down and the 10-year U.S. Treasury yields softening in early trade, equities were given incredible room to run. We literally saw an extension of the broader risk rebound. Just look at these numbers. The Nasdaq Composite surged 2.5%, the Dow Jones Industrial Average rose 1.9%, and the S&P 500 gained 1.8%. The market absolutely thrives on certainty, and the fading threat of an energy supply shock was exactly the green light these indices needed to push higher. Meanwhile, the U.S. dollar index also softened, completing a total shift in the broader financial landscape. Section 4. Gold and silver technicals. This quote from the Kitco AM Report gets right to the heart of a pretty fascinating market irony. Gold is not drawing a clean haven bid. Now, you might be thinking, wait a minute, if there's geopolitical news, shouldn't gold be shooting up as a safe haven? But it's actually doing the exact opposite. Because the headlines are all about reducing conflict risk, we're seeing that drop in oil prices. That drop in oil prices lowers inflation expectations. And since gold is famously used as a hedge against inflation, lower inflation expectations actually stall gold's momentum. It's this beautifully complex paradox where the good news for global peace removes the speculative fuel from the metal. Turns out world harmony isn't always great for your portfolio. So the crucial point is how this whole dynamic impacts silver, which actually slipped down to $67.02 on the session. Silver is currently trapped in a massive tug of war. On one hand, you have softer treasury yields, which is fundamentally good for precious metals. But on the other hand, silver is highly sensitive to industrial demand. When crude oil drops like a stone, the market often interprets that as a weaker signal for the broader industrial cycle. So silver is feeling the weight of that weaker industrial signaling, pulling it slightly down, even while gold holds steady. So what numbers should you actually be watching next? Let's break down the technicals for gold. If you are a gold bull, your immediate job is to push prices right through that first major resistance zone, which is between $4,215 and $4,350. If we see a sustained breakout above that, the targets become $4,500 and eventually $4,575. However, if the bears take control, their first major goal is to break below support at $4,104. If that floor gives way, we're looking at deeper downside targets of $4,000 and potentially all the way down to $3,900. So these are your absolute clear boundary lines for the weeks ahead. Now for silver, the battlefield looks roughly like this. Bulls need to drive the price back above the really tough resistance zone between $68.53 and $72 flat. If they clear that, momentum could easily carry silver to 72.47 and eventually up to the $80 mark. Conversely, the bears are looking to force a break below 66.09. If silver loses that support, the next major downside target is 62.15 before entering a long-term buy zone stretched anywhere between $60 and $50. Make sure you keep these specific support and resistance levels in mind as you watch the daily volatility play out. We've seen exactly how de-escalation in the Middle East can cool off oil, ease inflation fears, and send equities soaring, all while keeping precious metals anchored in a really highly technical tug of war. But looking at the broader, long-term picture, with trending market forecasts noting that rising debt and inflation risks absolutely still loom large on the horizon, the stage is completely set for a massive technical showdown. As prominent analysts point out, a challenge of the $4,600 momentum barrier may be required before true bullish momentum resumes. So, I leave you with this to think about. As the geopolitical risk premium unwinds today, is it simply coiling the spring for gold's next historic breakout tomorrow? Thank you so much for joining me.